And yes, we need to get to the OpenAI Anthropic race to an IPO. So much more to get to on the Floor Show. Joining me now, JPMorgan Asset Management global market strategist Jack Manley. Well, you get to pick.
Yeah, dealer's choice, right?
Dealer's choice on all of these moves here. But let's just start with the markets at records again.
Yeah, well, I think this is a continuation of something we've been seeing for a little while now, Liz, which is that underneath the surface, the fundamentals are still very strong for the equity market as a whole. We know this is an equity market that has been overwhelmingly driven by technology, AI in particular. You look at the underlying earnings that support those names. They're very strong, coming off an extraordinary first quarter earnings season. Everything else is just sort of noise. And for a lot of us that have lived through markets that have been ultra choppy over these past several years, the little bit of volatility that we saw at the beginning of this year was just more of the same. We know to look through it. We know to look past it. And I think that helps us support equity prices.
First quarter S&P earnings growth rate, 28.6%.
Unbelievable.
And your CEO, Jamie Dimon, said that the market looks exuberant. He said he's seen this before, but he also said exuberance can go on a long time. So do you advise people to stay in and keep riding the wave?
Here's how I think about it. You are looking at an equity market, a U.S. equity market, that is dealing with a combination of admittedly problems. It is a deeply concentrated market. It is a market where earnings are priced for perfection, and sometimes even perfection isn't good enough. And it's a market where sort of by extension valuations look a little bit rich. I don't think any of those things, even taken together, necessarily suggest that we're, due for a significant correction. But what they do mean, especially taken together, is that this is a market that is susceptible to shocks, a market that's vulnerable to headline risk. And that's what we've been living, Liz, right? That's what we've been living, for over a year now at this point. But even at the start of this year, you had Venezuela, you had Greenland, you had the Japanese government bond market, private credit, precious metals, the Citrini research report. Like, how many headlines have we, right? It's like, I know, because nobody's talking about it anymore because we're on to the next thing. But it's a really good reminder that there is no equity market more resilient than our equity market, and that any headline that may lead to modest downward pressure over the short term eventually gets overturned. It is also a very good reminder, though, that even when this Iran conflict, which is clearly one of the more top of mind issues at the moment, even when that eventually settles down, oil prices move lower, the inflation narrative changes, as I think it probably will, you're still dealing with an equity market that is grappling with a lot of big, heady questions. And so that means more volatility. So you lean into it, yes, but it's about looking beyond just the Magnificent Seven. It's about looking beyond just the hyperscalers.
Well,
it's a more diversified market.
If U.S. is resilient, so is the Kospi in South Korea, that one hitting another record.
That's right.
But as we look at oil prices and we look at the prices of everything that has plastic in it, and that's why we thought we got to talk to Ynon Kreiz, just as Masters of the Universe is coming out and all the toys that come with it have a plastic component to it. You also have this great S&P earnings picture from the first quarter, except that there is a whole chunk of American population that hasn't exactly gotten to partake in this. You've been looking at that. How much does that play into a future, perhaps, correction?
It's an interesting and very touchy subject, obviously. When you think about the equity market, of course, it is accessible to anybody. Anyone can invest in the stock market. But in order to invest in the stock market, you got to have discretionary income to do so, right? You have to have extra money beyond what it is that you're spending on rent and groceries and now higher gasoline bills. And so just by nature of that dynamic, typically the owners of securities, the ones that have benefited so much from this market run, have been those higher income, higher wealth individuals. It's that K-shaped economy. Now, in general, when you look at consumption in this country, the highest earners, the wealthiest people, they do the bulk of the heavy lifting. So from an economic perspective, from like a GDP growth perspective, it's fine.
And they're going to pile into the Anthropic IPO and eventually the OpenAI IPO. The new news, of course, is that Anthropic confidentially filed the papers to go public. This has been a race between these two. These are mega IPOs. They're going to suck that, plus the SpaceX IPO, going to suck a lot of money into arguably that same halo that is encompassing the AI trade. And does that then concentrate people's portfolios still a bit too much?
So whether or not it's too much is entirely dependent on what these companies are able to generate over the long run. I will say, though, that it does further concentrate the market, and it concentrates it in an even more insidious way than I think you get at kind of headline level. This idea that the hyperscalers have been big drivers of equity market performance for the past several years, everybody understands that. But they also understand that those big hyperscalers have business models that pre-existed artificial intelligence, right? Some of these names that have been driving so much of the spend have been around for decades. They figured out how to make money long before AI and large language models were a thing. When you are talking about new companies entering the equity market at very high valuations, presumably, and doing so where their business model is much more focused just on pure play AI, you are, of course, more deeply concentrating that AI story, but you're removing some of the diversification benefits that you see in other pockets of the tech market. And that, I think, is interesting at the very least.
Interesting is a good way to put it. Fascinating. Once in a lifetime. We're watching it all happen right here. Great to see you, Jack.
Thanks, Liz.
All right.